Welcome to Centaur Financial Services Podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Good day, everyone. Welcome to another episode of the podcast. I'm Bobby. We're here with Nick. We're the advisors here at Centaur Financial. We've been having a lot of discussions with clients, as we do every week, and there's been a couple of questions that kind of keep popping up really frequently that we thought we might address today, specifically in relation to superannuation. So what we're going to do is we're going to do today just questions around super that are kind of common that we think we can touch on and just provide a bit of information for everyone. And then in later episodes, we might do one on debt management or estate planning or things like that. So what we've done is we've written the questions down that are kind of common to everyone, and we popped it into this little bucket here. And what we'll do is just basically read out the question, provide a bit of commentary on that, and if you have any follow-up after that, please email, call me, and we can go through it. All right, Nick, did you want to do the honours? Or?
Yeah, sure thing. Now, I must stress, so everything we talk about today is just general information. It's not personal advice. Please speak to your advisor regarding your personal situation. All right, but let's jump into it, Bobby. So the first card off the rank today. So I've got a defined benefit fund. Would it be better or worse to have these funds in an accumulation account?
Yeah.
So do you want to start off by just explaining what the differences are between the two and then maybe the intricacies of that?
Sure. Okay, so starting with an accumulation account, essentially that's what vast majority of you would have. Essentially, it's an account where you contribute to those funds in there are invested and they grow over time, and that's your retirement savings, basically, really simplistically.
Yeah.
A defined benefit's a little different in terms of to calculate your benefit. It's actually an equation rather than having money invested, so to speak. So depending on your average salary, how long you've worked there, and a few other factors will determine what your benefit will be at the end of the day. So main difference is you're not necessarily subject to what the market does. You kind of get a prescribed rate of return over the long term. So the longer you work there, the higher your salary, kind of bigger the end benefit will be. So do you want to touch on which one may or may not be better?
Yeah, I suppose it's good to probably highlight the differences in between them. So depending on your employer, maybe a previous employer to where that defined benefits really started from, and the choice you get on the other side, which is accessing it via retirement. So I know many government-based ones, you are provided with a lifetime income stream out of that defined benefit, which might be indexed with CPI commonly. So providing that income stream when you're in your retirement years to help with your living expenses and whatnot. So with those sorts of defined benefit funds, you don't really get a lot of choice as to whether to move that over to accumulation. So the choice is somewhat made in regards to that aspect. But it's becoming more and more common that a lot of defined benefit funds do give you an option to commute that across to an accumulation fund or take it as a defined benefit or even just cash it out completely upon retirement. Is it better? Is it worse? Again, it's always going to come down to that individual circumstance. I suppose some of the benefits, like you've highlighted with the lifetime income stream option with your defined benefit, is that it isn't subject to market returns. But that could also, end up being a negative as well if we've got really good markets for a consistently long period of time. Downside of defined benefit, upside of accumulation is that you just have a little bit more choice. So if you've got that lifetime income stream option, there's no ability to be able to withdraw a larger lump sum. For instance, if there was renovations on the home that you wanted to do, or take that large overseas holiday, where you do have that flexibility with the accumulation. So it's really one, understanding what your choices are if you have that option. It's not very common anymore. You can't go and open a defined benefit fund anymore either. It's if you've got one, you've got one. If you don't, you'll never have one. So hopefully that answered your
pretty much.
Yeah.
The conversations I have with clients, mainly just touching on what you said, the flexibility piece is everything. With the accumulation, you can have access when you meet your condition of release. If you got the income stream option, you're stuck with that income. It's indexed with CPI, no market volatility, but that's kind of it.
Yeah, good.
So what's the difference between a reversionary beneficiary nomination and a binding death benefit nomination?
Mm-hmm.
And which one is best, if there is one?
Good. So I suppose it's good to highlight which phase you're. So what these are, they're estate planning considerations within the superannuation environment. So your binding death benefit nomination is essentially choosing your beneficiaries as to where those funds are going. So for instance, you might be allocating 50% to your spouse and 50% to your child, and you have that choice from a death benefit nomination. So when you pass away, that's how your estate within the superannuation environment will be split up. Reversionary beneficiaries only really you're only really considering that when you're in the income stream phase or account-based pension or allocated pension, whatever term you wish to use for the income stream phase of superannuation. And basically what that is, the person you're choosing as a reversionary beneficiary will just continue to receive the pension that you were individually receiving after the death of that member. Positives and negatives to both, obviously. So if there's some people that you can't choose as a reversionary beneficiary, so it's really going to depend on who your ideal beneficiaries are. You can't, for instance, put it towards your estate from a reversionary beneficiary. It needs to be someone in particular. And then you've got obviously the binding death nomination on the other side, which does provide you a bit more flexibility of who the funds are going to. However, it doesn't provide you that instant income, so there is a bit of paperwork behind the scenes that occurs and how those funds are paid out and whatnot. Is there anything you'd touch on there?
The only thing is with the reversionary, obviously only available in that account-based pension phase or retirement phase, whatever you want to call that, is it means the funds can stay inside superannuation, whereas with the beneficiary nomination, the binding has to come out. So that's the difference. Is so, say a couple in retirement, often reversionary means they can kind of keep things almost exactly as is, but the account will just switch over in terms of names. Whereas with if it was a binding nomination, that surviving spouse then has to receive all the money in the hand, which they may not be able to get back in a super, and they start getting taxed on that. So it's definitely a consideration we have here for sure.
Yeah, and I often see that changes depending on the circumstances of each person, right? So there's estate planning needs might change over time as different people come into the family and exit as well, by whatever way that is. But yeah, it's a flexible component to your estate planning part of super.
Nice.
Good.
All right, you're up.
All right. So the next question is, if I'm wanting to establish a self-managed super fund, what are some of the things I need to know?
Yeah, right. This could be an episode.
So,
all right. So self-managed super fund. Essentially, I'll go through kind of what that is to start with. It's in the title. You're self-managing your own superannuation as opposed to having it, say, a retail fund where all that investment decisions are made for you. So it's a vessel essentially, and you have your assets in there, your retirement assets in there invested, which you manage on an ongoing basis. So there's complexities around what you can and can't invest in the self-managed super funds. The trustee structure, whether you're a trustee, you have a corporate trustee, and how many members you have, how many you can have. There's just
regulation of it as well, protections, all sorts of things.
There's just a lot that goes on in superannuation in the background that we don't see with retail funds, which you then have to manage with a self-managed. So the main benefit's probably flexibility and control. You'd probably say. And as you kind of get a bigger balance, economies of scale start to come into it because your flat fees are kind of imposed on the self-managed super fund become a smaller percentage of your overall balance, which makes it more cost effective. But at the moment, obviously, with retail funds pricing coming down there already.
It is a race to the bottom a little bit. So you've got the flexibility of the assets you can own inside of there. Yes, it might come at a higher cost, but there is economies of scale as your balance grows there. For the day-to-day investor, is there much of a difference? What would you be considering if someone was saying, okay, I want to open up a self-managed super fund?
So initially, you're considering balance and whether the economies of scale are there. Obviously, the higher the balance, the more appealing it starts to become from a cost-effective kind of perspective. So that's one thing. Their kind of appetite for managing it themselves and kind of financial literacy around that, because you do kind of need a team to manage it. You need an accountant in there. It needs to be audited. generally a financial advisor there helping to manage the investments as well.
Mhm.
It's quite a heavy, burdensome process, and if
Yeah.
you're not up for it, then potentially that's not the way to go. There's other options you can look at.
Yeah.
There's some of my main considerations on what you're looking to do, and then again, who's going into the funds. If it's going to be someone retiring and someone that's 30,
Yes.
very different investment strategies. So that might distort how the investments are chosen when they're self-managed. But say two people going in there, both in retirement, they want to purchase some investment property.
Mhm.
That might be something we start to look at.
But if it's in the example, for instance, a lot of people are considering self-managed super funds because they want the flexibility of owning certain companies or certain shares within there, and the industry fund's not giving that flexibility. Is self-managed super fund still the right option, or is there? I see there's something in between. I feel if that is the pure reason why you're getting into self-managed super funds.
Yeah, for sure. I mean, there's products now available that are kind of in between the retail and the self-managed space where you can kind of pick your own shares and your own underlying investments. If you want to look at that, you're speaking to a financial advisor, great time to do it. Self-managed is definitely the top end in terms of you want control. The most I hear about now is people wanting to get into direct property. Because it is a vessel to do that. But yeah, there's just a lot of complexity that comes with that. So definitely having a chat with one of us makes a lot of sense on that.
Good.
Anything you want to add?
No, it's good.
Nice. All right. Alrighty. What have we got? Okay, so can we please explain the potential implications and rules around the proposed $3 million capital superannuation?
Good. Timely one. So what are we? October, the draft legislation has come out in regards to this. Formerly the $3 million super cap, now known as Division 296. So not to be confused with Division 293. So basically, there's a couple of steps that go into how that's basically calculated. What are the considerations? I think from the outset to understand, okay, when is that basically looking to occur? So 1st of July 2025, does that actually happen? Well, we've got an election in between now and then as well. So there are, yes, there's things you can do to start planning towards it. But I'd be pumping the brakes in a way purely because it could not come into fruition in its current state and form. How it works, essentially, there's been a lot of talk about unrealised gains being taxed. How they're going to look at it, and from an earnings perspective rather than an incomes perspective, is the earnings that the fund has made. So, for instance, if you've got a fund at the start of the financial year worth $3 million, and by the end of the financial year it's $3.3 million. The earnings allocated to that fund is $300,000. And then the next step to that is that they're going to be looking at, okay, well, there's going to be withdrawals coming out of some funds. There's going to be additions going to other funds. So they're looking at what are the net contributions and withdrawals to that fund, and that's going to either be added to in the way of withdrawals coming out, that's going to be added to the earnings, or withdrawals for contributions going in. Alrighty. So then the next step after that is what we're looking at is what percentage of those earnings is for the balance over $3 million. And then that's where this additional 15% tax is going to be imposed on top of that. So remember, it's additional. Because
15% tax and then 15% tax on the top for that amount.
Yeah, that's right. So similar to, I'm going to confuse the terms a little bit here. So we know with Division 293, where your income's over a certain amount, you have to pay additional tax within that superannuation environment. Now, how that tax is imposed is you get the choice of withdrawing that from super or paying it in your personal name. That's going to be the same option with this sort of thing there. So for those with that as an issue, it is something to start considering, but then you're really playing that off against, okay, well, should I start looking at withdrawing funds from super? Maybe not. It's really depending on what your value is there, but you've got to play that off against, okay, well, if you're withdrawing funds out of super and holding that in your personal name, say you've got $6 million in super, okay, I'll take $3 million out, hold that in my personal name. Now, if you go invest those funds in your personal name, that's getting taxed at the marginal tax rate. So there is that whole holistic thought of what's my total tax going to look like across all entities, whether that be personal, superannuation, family trusts and such. And that's really a conversation to sit down and review with your advisor as new information comes to light around the proposed change. but also, in individual circumstances is really key as to what changes should or shouldn't be made.
Yeah, and that's a per person $3 million.
That is a per person
Yeah,
$3 million
right.
cap.
I
So
had that comment the other day. So if you have self-managed,
Yes.
it's $3 million per person, not total.
yeah, that's right. And look, it isn't ideal with it being unrealized gains. It's the total value of earnings. So what was the balance at the start and what was the balance at the end?
Mhm.
But from the government's perspective, they can't really look at it from an individual member perspective. They can't look at what's a total fund, what's Australian Super made in total, and then
Yeah,
leverage
right.
that against all members, some that have 10,000, some that have 6 million.
Mhm.
So they're trying to do it in the most fair and equitable way possible. Does it come into place in its current form? I'm not sure. There's still a bit of time in between now and its proposed start date. So we'll keep a finger on the pulse around that and keep everybody updated as we learn more. But it's definitely an interesting area to see how that unfolds. Anything to add?
Nothing to add.
Perfect. Good
Covered
stuff. All right. Question for you, Bobby,
Mm.
is can you please explain this superannuation death tax we keep hearing about and how that might be charged?
Right, okay, this is a good one.
Mm.
So before we touch on binding beneficiary nominations and those kind of things,
Yeah.
essentially there's a couple of different categories of beneficiaries in super, and if we go for where the tax implications could come in, that's for non-dependent beneficiaries.
Mhm.
So most commonly you see is for adult children and the like.
Yep.
So if they're listed as a beneficiary and they receive a benefit from super, there could potentially be tax implications for that. So what you'll find is your superannuation is comprised of two elements, a taxable and a tax-free component.
Mhm.
Now, when these funds pass to a non-dependent beneficiary, the tax-free component is always tax-free.
Yep.
That's just how it is. The taxable component, however, in this particular situation, can have tax imposed of 17% on that. So when received in the hands of the beneficiary or by the state or whomever, that tax is levied on the taxable component. So if you had 100,000 in there that's received by a non-dependent beneficiary,
Mhm.
then 17,000 that could potentially be taken in tax.
Okay.
So that's a little bit nuanced there, but there is the unofficial death
Yeah.
tax. It's not technically a death tax.
So there's no death tax in
There's
Australia,
death tax in Australia.
but there's a little bit.
Yeah, yeah. So and then strategies around that.
Yeah.
Yeah. So you've probably heard it before, the cash out recontribution strategy.
Mhm.
Essentially, there are ways where we try to increase the tax-free component of your superannuation to ensure that when the funds do pass in that scenario, the amount of taxable component in the super is lesser, so there'll be lesser tax imposed.
Great. So sort of what sort of ages are you considering those sorts of strategies around?
Yeah, so it depends on who you want as beneficiaries.
Yes.
If yep, absolutely you want your adult children as beneficiaries and you're kind of in retirement,
Mhm.
definitely considering that there. Their different beneficiaries will have different tax implications, like spouse as opposed to say adult children
Sure.
or your estate. So essentially, depending on how you want those funds to pass and what your kind of ages and your views are around that, will depend on what we're looking for there. And if we do that cash out recontribution strategy, which if we want to do that, you have to be able to contribute and withdraw at the same time.
Yep.
So there's
Okay.
a window in terms of age where we can do that. But again, talk to your financial
Yeah,
advisor
not
about
personal advice.
correct around that.
Good. Perfect.
That's it. All right. Nice one.
Last question.
Last one, lucky last. All right. So the question asks, why would I invest in superannuation as opposed to investing in your personal name, considering the legislative risk associated with super?
Good. I get this a lot, funnily enough. So I think it's very important to understand what superannuation is.
Mm.
And at the end of the day, it is a tax structure.
Yeah.
So like we said before, with whether it's a self-managed super fund, whether it's a sort of retail fund, industry fund, that comes with a different level of flexibility in each. But essentially, for all intents and purposes, you can hold the exact same assets in a super, in the superannuation phase, as you can in your personal name.
Yep.
So that's why we're looking at it as a tax structure. We know when we're in that accumulation phase prior to retirement, the earnings within the superannuation environment is taxed at 15%. When we're in pension phase or retirement phase or over 65, we know that the earnings within superannuation is tax-free.
Yeah.
So that is in itself one of the greatest benefits there.
Mm.
Of course, there's other options available where you don't want certain funds to fall as part of your total estate and you want that to flow through beneficiaries, so you can use it as a bit of an estate planning tool as well.
Yeah.
But for all intents and purposes, holding the same amount of funds in your personal name versus superannuation, there tends to be more often than not a better tax outcome for you long term.
Yeah, I think touching on capital gains with that one too
Mhm.
is a good one. So if you have those funds in your personal name and you sell an asset that's made a gain, the gain is net gain is added to your assessable income tax and your marginal tax rate. Whereas if you're in pension phase and you make a capital gain, because it's a tax-free environment, there's no tax implications for doing that. So it gives you so much flexibility in terms of being able to avoid that tax. Often you can't find a better strategy from a tax perspective in superannuation as opposed to holding it in your personal name.
Yep. Good.
So
that's pretty much it. I guess just to reiterate a little bit, like you pay tax your whole life. Ideally, when you stop working, that's when you stop paying tax for most. With the use of superannuation, that is possible if you've built sufficient wealth. But avoiding that, you may be paying tax for your whole life. So that's why we continue to reiterate the importance of it.
Yep.
We love it. I think there are great strategies involved with it.
For sure. All right, well, that's the end of the question bucket for today, so we'll wrap it up there.
Right.
If you have any additional questions, shoot them through and we can go through those in a later podcast. Otherwise, thanks for listening and we'll see you soon.